Hey, good morning, everyone. Marty Mazzari here. Wednesday, the 2nd of November, 2022, with your midweek market snapshot. Today's Fed day. We're going to get a rate decision here at 11 o'clock Pacific time, our time here in California. And we're going to get 0.75% increase. And if this particular meeting were 3 weeks ago, I think the Fed would have sounded rather dovish or softer on their inflation fighting endeavors than they will today, would be my best guess. The market has had a really nice run since then. And back then, they were expressing in their tone real concerns over, I think, something blowing up in the credit markets because of, widening spreads, rising yields, what happened in the United Kingdom, written quite a bit about that, talked about it as well. Again, since then, the equity market obviously has improved, and so has the credit market. Our stress index, our financial stress index, has come off the boil a bit. I mean, it's still elevated. There's no doubt that risk is out there. And if they do something today that just, crashes markets to be extreme, well, then, those spreads are going to widen and they're going to be worried about it again. But I'll say it again. I don't know that they're going to come off quite as dovish. Therefore, the market may not like the tone. What the market's going to be looking for is, what are you going to do in December? Are you going to continue with the 75 basis point hikes? Are you going to drop it to 50? And then what happens beyond? What they need to do, and I suspect they will do, is say they'll be data dependent. All options are on the table. If they suggest that the terminal rate might be too low, the gentleman at the Wall Street Journal, who's believed to be kind of their conduit when they want to get a message to the market indirectly, is suggesting lately that the terminal rate may need to be higher. And if that's the case, and they say that today, who knows? We'll see how the market treats that. Wouldn't like it. Wouldn't the market wants, the markets, I should say, or players in the market, at least short-term, want the Fed to begin backing off. The argument for that would be the delay in the transmission effect of higher rates and how they impact the economy. So there's that lagging effect that they can speak to. Again, financial stability risks that are out there and so on, no doubt have their attention. But a rising stock market is an easing financial condition, and that's not how you beat inflation, as I said in yesterday's note. From a technical perspective, things aren't looking quite as good as they have my last couple of video reports. You can see here on the weekly chart, we are still above the downtrend line here. We are still, piercing that. That's that blue candle right there. Finding resistance at the 20-week moving average. Still have a falling wedge, still have bullish divergences, still have a nascent buy signal here on the MACD. So the weekly still looks constructive, coming back and testing now that downtrend line from above. The one-year daily chart, which has looked really bullish of late. Little less snow now as well. Still have a buy signal on the MACD, but you can see the histogram is showing that that's beginning to roll over. So losing some momentum there. You see it here on the RSI. And we did break above the 50-day moving average with momentum and have been fighting. Remember I said in the last video, 3,900 is going to act like a brick wall. Well, indeed it has. You've got lots of resistance there, the 50% retracement of this downturn, and then that round number, and you see it's in a kind of a battle zone here. It was support, it was resistance, it was support and resistance. So again, that made a lot of sense, and that's playing out. That was an easy call to make. Now testing the 50-day moving average. Of course, it's all about today and what the Fed says, and then maybe even bigger, it's about Friday's jobs report as well. So breaking above the 20-day moving average, like it has been when you get it to turn up as well, has been very bullish for at least a good bear market rally. This one I think could still have more legs regardless of what happens today. But right now, you can tell the market's getting jittery. It's showing up here in the technicals, and it's really showing up on the hourly chart. You may recall on the last video on Friday, We still had a pretty bullish setup both on the weekly and the daily, which are deteriorating a bit here. But I said the hourly wasn't as constructive, and it's really not constructive now. Now you have your very classic rising wedge pattern that we're just breaking out of here late yesterday and today. And then just really notable bearish divergences on the MACD and the RSI. And we're about to go into that bearish territory here. And again, this is just a short-term hourly chart. If the Fed comes in easy and soft, they're going to know that the market's going to ramp up strongly today if they do. If they come in, somewhat hawkish relative to where they've been of late, the setup is for the market to come, barreling down. Again, we've seen lots of volatility, so nothing about this Fed meeting says that, we're going to go down and pierce that 3,500 low that we established here recently. But, we could certainly see some downside volatility today. I don't think the Fed really is interested in crashing markets because now they're concerned about that systemic risk, something breaking. I certainly don't think they want the equity market to go barreling into new all-time highs anytime soon. We just scored our equity market conditions index, which we do once a month. I reported on that this morning. I said the technicals looked favorable relative to a month ago, and they do. The dollar, actually, we were more bullish in terms of the dollar's impact on the market, and we're back to being more bearish now. And that's all about our short-term technical analysis there. We have our own long-term macro thesis with relation to the dollar, but on that monthly equity market conditions index, it just speaks to what we're seeing in the technicals. We do this kind of analysis. And last month in September, we went from a very low -50 to a -25. So we had improving conditions, and that really showed up in October. We basically broke even on that -25, which says, I still think there could very well be some life left after today, regardless of what happens today and Friday with the jobs number in this Q4 rally setup. But it's not nearly as strong looking in terms of likelihood as it was, at the beginning of the quarter. And of course, we got a nice boost here in October. So we'll see. But our base case is that beyond whatever is left in this rally, if anything, that this market's going to struggle with really getting back on its feet until we kind of factor through the impact of a slowing economy on corporate earnings, and perhaps in the first quarter of next year we actually do find a durable bottom in this bear market. All of this is subject to change. It's all dynamic. We're not strategists who create a thesis and then look for bias confirming evidence. In fact, we're trying to look for as much disconfirming evidence as we can so that we see the market for what it is and invest accordingly to the risk reward setup. We do think we're closer to the bottom than we are the top. We are making some adjustments, finding some value that we don't want to wait on, necessarily, but staying hedged against something, cataclysmic to the downside. So be an interesting day, no doubt. Look for volatility, and I'll write about it tomorrow morning. And then the next video update will be either Friday or over the weekend. Folks, thank you as always for watching and listening. Hope you have a great rest of the day. Take care. Bye.